Welcome to our webinar on a holistic approach to investments, taxes, and insurance. Now, before we get started, I have some housekeeping notes to share. On your browser, please note that Firefox is the preferred browser for GoToWebinar. For questions and answers, if you have questions, feel free to contact us via the following methods. 1, the question box. Please ask your financial questions via the questions box on your dashboard. If we don't get to your questions during the webinar, we will be able to respond via email. 2nd, the chat box. Use the chat box for other comments or questions during the webinar. Note that group chatting is not available, and all chats are direct messages to our staff or by email at webinars@kjzz.org. Now, for technical assistance, please call the GoToWebinar support line at 888-259-8414. Now, this discussion will last for about an hour. We do have qualified volunteers from the Central Arizona Estate Planning Council available to answer your questions. Now for the disclaimer. Situations regarding taxes, investments, and insurance are unique. The opinions shared by our panel cannot take into consideration all the possible situations faced by our audience. Viewers should seek counsel prior to taking any action on the topics discussed here. Now, before we get started, let's introduce the panel. I am Steve Taddie. I'm the co-founder and managing member of Stellar Capital Management. I've been in this business about 30 years and have worked with a range of clients from corporations to government entities, Native American tribes to high net worths and families across the country. I'm a member of the National Association for Business Economists, a panelist for the NAB Outlook, the National Forecast, the NABE Financial Industry Roundtable, the Western Blue Chip Economic Panel, and a member of the Arizona Legislative Finance Advisory Committee. To my left is Greg Cygan, Vice President of Northern Trust Company. Greg, say a few words about yourself, please.
Sure. Thank you, Steve. My name is Greg Cygan. I'm with the Northern Trust Company. I serve in the Wealth Advisory Services Group, serving high net worth individuals and families. I've been with the bank 16 years, serving primarily in trust administration. I have an undergraduate degree in finance from the University of Arizona, a law degree from there as well. I'm a member of the Arizona Bar Association and currently a member of the Central Arizona State Planning Council.
Super. Thanks, Greg. And Barry McBride, President of Sun Cornerstone Group. Barry, a few words about yourself, please.
A few words. Founder of Sun Cornerstone Group. We specialize in the area of life insurance, and we apply life insurance into areas of estate planning, business planning, and also financial work. Been in the Valley for, since 1965, and in this business for 37 years, member of the $1 Million Roundtable, top of the table, a member of the National Association of Insurance and Financial Advisors. We enjoy our work planning with clients. That's what I have, Steve.
Thank you, Barry. Mm-hmm. And to Barry's right, James McGettigan, CPA, tax manager of the Washington office, Grant Thornton.
Sure. James McGettigan, glad to be with you guys this evening. Born and raised in Arizona, went to Arizona State University, got my undergrad in accounting and master's in tax there. At Grant Thornton, we specialized in high net worth families specifically and individuals. Our group is private wealth services, so pretty much anything. We're the quarterbacks for clients, financial related and tax.
Super. Thanks, James. So now for our questions. The first question is, with interest rates so low, the amount of money I calculate that I need to retire has gone up substantially. Have I just picked a bad time to retire, or are there some alternatives I'm missing? Well, I could take a stab at this one. And yes, interest rates are low, and they have been for quite some time. If you figure at about a 5% interest rate, it takes about $1 million to generate $50,000 a year in interest income. That's at 5%. Where we are today, let's call it 1% in the money markets and many CDs, you only make about $10,000 a year. That's a big haircut, about a 75% haircut from where you were with interest rates being a lot higher. So what are the options? One of the options is that an investor can go out into longer maturities, taking interest rate risk. For example, on the U.S. Treasury market, the 5-year U.S. Treasury is yielding about 1.4%. The 10-year Treasury about 1.9%, and the 30-year Treasury about 2.7%. So you can almost double your income going from 5 years to 30 years. That's a pretty big step though. Another option would be to lower the quality of your investments to things besides U.S. Treasuries. Now, based on a range of different non-treasury investments, you might be able to add between 2 and 5% a year to your income, depending on how low down the ladder of quality you're willing to go. Another option would be to compromise liquidity. And treasuries are the most liquid investment out there. There's a huge amount of them. You can buy and sell them at will with no concern for who's on the other side of the transaction. There are always willing buyers of treasuries. If you go into lower liquidity issues, that might be things like preferred stocks. It might be things like variable rate securities where there's just not a lot of volume on a daily basis. You might be able to add about 1 to 2% a year to your income over more liquid, higher quality investments. Another option is stocks. Common stocks are yielding much greater than treasuries. For example, stocks like Exxon and Procter & Gamble are yielding in the mid-3s, Pinnacle West in the mid-3s, REITs between 4 and 6%. But then you ramp up the volatility of your principal in the portfolio. Or you could venture into other packaged products such as mutual funds, ETFs, and a variety of insurance products. It's a pretty broad spectrum of things that one can look at if low interest rates are a barrier to creating the income that they need to retire. Let me throw this question out to the panel for any color or thoughts from the panel.
I like to leave it up to my portfolio managers at the trust offices. I got to admit that. But my one question I might have for you is, what is your appetite toward high yield bonds, which are known as junk bonds? They have a bad rap, but at the moment, those seem to be yielding obviously better than investment grade. Is the economy in a situation where you're comfortable entering that market, or is the economy too volatile in your opinion that that's a reasonable choice?
That's an excellent question. I think they should be called junk bonds too. I think high yield is just a kind word for them. But junk bonds come in a couple different varieties, and it seems like today there's a disconnect between junk bonds that are in the energy segment and other junk bonds, non-energy, non-material type bonds. And the yields are different as well. You probably pick up, not to get too technical, but everything is priced on spreads over treasuries, and you might see energy bonds at about a 500 to 600 spread over treasuries or higher, and your average run-of-the-mill junk mill might be a bit lower than that. It's not for the faint of heart, because you have a lot of event risk there. The companies are classified as junk because there's questions regarding the repayment of principal and or interest.
Right.
Thank you.
I think one thing I would just add is we're very focused on yield on this question, when we also should be focused on cash flow and around the client's risk tolerance. So adding high yield or junk bonds changes the risk makeup of the current portfolio from 30-year treasuries or quote unquote safe 1% yielding investments. So those are things to take to your advisor to say, all right, so if I'm going to add MLPs, master limited partnerships, to increase yield, REITs to increase yield, if I'm going to go into the Dow 30 to increase yield, or whatever it is, ask that question. What is a potential loss in a given year, in a given 5-year period, 10-year period, and can I stomach that? So
That's great color. That's wonderful color. And a thought I had neglected to mention that I think might be important for the viewers is there are two other interest-paying investments that exist out there that we didn't talk about. One is CDs, and the yield on CDs is somewhere right around the U.S. Treasury market.
It's
You know,
negative when you take into account inflation.
Absolutely.
So you're already losing money.
Absolutely. And then tax-free bonds. And tax-free bonds are in about the same range yield-wise as U.S. Treasuries. However, they are tax exempt at the Fed, and if it's an Arizona bond, Fed and state level. So there's a lot of options out there, and James, your advice in taking counsel with your own investment advisors, good advice, absolutely. Let's move on to question number 2. Most commonly used Arizona tax credits for individuals. What are they? Who qualifies, and can I still benefit for 2015 taxes? I think that'd be a great question, James, to throw back your way.
Sure. And I'm glad to take it. Yeah, so the premise behind this question is, well, what can I do for viewers listening now and watching online or in the rebroadcast? What can I do for that April 15th deadline? Is there anything I can do with taxes now, or am I just too late? And so one of the things that this points out is that there are things you can do today, specifically to offset Arizona state income tax. The key credit being the school tuition organizations. And so there's two types of this, but generally they work the same way. So you can make the credit today, and then but you have to elect to treat it for 15 taxes or 2016, and you kind of some organizations request that in advance, or you can decide where to put it on the taxes for what makes sense. The only caveat is you don't get to deduct it on 2015 taxes because you've made the contribution in 2016. So it's a 2016 deduction, but the way Arizona works, you can kind of reclass that and it becomes a credit and it offsets your 2015 taxes. Some other areas to look at, and these specifically focus on, all right, if I've got some charitable intent rather than just writing a check to the Department of Revenue, what can I do? And so the other area is public school credit. It's a $200 credit for singles or head of household, and $400 for married. And so this is basically like extracurricular activities that students in like high school, elementary school, middle schools get to take advantage of. The other area is qualified charitable organizations. And so this is kind of interesting. There's a few years ago, they added an increased benefit for foster care related charities. And so that brings it up to a $400 credit for single, $800 credit for married. And so, but with this one, you've got to be careful. You've got to and also with the student organizations, you've got to make sure they're registered with the Department of Revenue. So you go on their website, make sure your charity is included in a couple of the PDFs they publish so that it indeed qualifies. And so the non-foster care would be charities that support working poor, homeless, things like that. A little lesser known credit, but there's a cap, $1 million cap each year, is the Arizona Military Family Relief Fund. And so this is put on through the Department of Veterans Affairs. It's a $200 credit for singles, $400 for married. And basically it kind of, you send them a check, you fill out a form, and they send you a letter, and you have to have that letter in order to take the credit. Generally, I think this kind of caps out in the fall. So if you're earlier, the better for this credit, so you can get that letter. And then just one other thing to add on the school tuition organizations. There is a corporate credit for this. It's very specialized. It literally caps out overnight. And I think it's every fiscal year. I think the state of Arizona's new fiscal year is like July 1. So employees at the tuition organizations are up at midnight making sure to get these contributions from their corporate clients, so to speak. So the reason why I bring that up, if you've got an S Corp or a small business company, you would be eligible for an increased credit. It's incredibly hard to get though. So,
Excellent.
Yeah.
Thank you. Any other color to that from the panel?
Boy, that's pretty comprehensive.
Yeah. And this may not be the right topic for a tax credit, but in terms of reducing taxes, it's still not too late to do an IRA contribution or a SEP contribution, right?
right, up to the April 15th, I believe.
Yeah.
And so those are IRAs. We might touch on a little later, but the key there is: are you covered by a retirement plan, or are you just kind of out there on your own? So does your company provide a 401k, some kind of pension plan? And if so, there's some limit tests we've got to overcome. Generally speaking, the traditional IRA is lower, and most people cap out at that. But the Roth IRA, some people still would benefit from. So, yeah.
Super. Let's look at the next question. It looks like another tax question, James. I am employed with W-2 wages. Can I benefit from my unreimbursed business expenses?
Yeah. It's interesting. This surprised a few people that I know this year as well. So these types of expenses, investment fees, legal fees, if they meet certain qualifications, unreimbursed business expenses, they're all subject to something called like a miscellaneous itemized deduction. So you've got to exceed, those expenses to get a benefit have to exceed 2% of your AGI. So if your AGI is $100,000, they have to be greater than $2,000. And so what's interesting is what encompasses those are things like job search things. So if you fly on your own to go interview in San Francisco or New York and that's not reimbursed, or you just forgot to send it in or having trouble, you can deduct it. Things like many companies reimburse for mileage and certain meals and entertainment, but anything that is disqualified under your company's plan and used for business could benefit here. And so when you combine those things with investment fees and legal fees, you'd be surprised. You might see an additional benefit there. So this question, I think, really just says, hey, let me look at what I've done for the year and let me just quickly add it up and see if there's a benefit. So,
Okay.
yeah.
Any other color on those expenses from the panel? Okay. We have an IRA question. Can I fund an IRA for my child or grandchild? Greg, let's turn this one to you.
Sounds good. I think that's a great idea. And yes, you can within parameters. Why do I think it's a great idea? You look at the papers every day and you see stories about how expensive college tuition is today, the student loan debt that the students have. On top of that, you look at Social Security, the retirement of baby boomers, and what stress that's going to put on Social Security. So the extent that you can get a retirement plan set up for a minor early, boy, that's going to put them in a good position. Now, how do you do that? Many institutions will give you the opportunity to open a custodial IRA. And you can do that as soon as possible, and there is no minimum age for setting up a custodial IRA, as long as you have earned income. So as soon as your minor child has earned income, that'd be a great time to think about opening up an IRA for that minor. Probably the best IRA that you would want to go with is the Roth IRA, given that a minor, thinking about how much they earn working at McDonald's over summer, is not very high, so they're going to be a very low income tax bracket. So why not put the funds in a custodial Roth IRA, knowing that when it comes time to take withdrawals, you're going to be in a much higher income tax bracket, and those Roth distributions, qualified distributions, are not going to be subject to income tax. So I would suggest a Roth IRA. Again, contribution limits are going to be $5,500. So a child can only contribute to that custodial IRA up to the amount that they've earned. So if they've only earned $3,000 over the summer working at McDonald's, well, that's all they can contribute to that custodial Roth IRA. What else I would suggest too is that if they're earning income from jobs that don't provide a W-2, such as perhaps babysitting or cutting the lawn, you got to be very careful with your records, meticulous with your records. You're going to have to file a return so that you're able to claim and go ahead and fund that IRA using those earnings. I like the custodial IRA for another reason. I think it encourages minors to save and to work, to be perfectly honest, because there's no saying that the exact dollars that that minor earns from the job are those dollars that have to fund the custodial IRA. So a parent can say, son or daughter, you make $5,000 this year, I'll go ahead and match that $5,000, but I'll take that $5,000 and put it in your custodial Roth IRA, and that minor child can go use that $5,000 on whatever a minor child spends money on these days. So that's a nice little incentive to work and to save. It's also not a bad idea to tell relatives around holidays and birthdays that, you know what, cash might be a better option than giving different kind of presents. We can use that to fund the custodial IRA, but again, up to the limits of their earned income. One thing about contributing for your minor's IRA, never put their retirement before your own. Your retirement should come first. To the extent you have ability then to fund a minor's IRA, go for it. I think it's a great idea. There are risks. Once that child becomes an adult and no longer a minor, that custodial IRA is no longer a custodial IRA, it's that child's now adult's IRA. And they can do with it as they wish, which means they can withdraw. So keep that in mind. Another benefit, at the end of the day, while it was set up to be a retirement account for the child, there are other uses that they can put it toward. They can put it toward higher education expenses without any penalty or income tax consequences, or toward the down payment on the purchase of a home, their first home. So I think it's a great idea, if there's money available, to go ahead and fund a minor's IRA account early.
Excellent answer.
Yeah.
Any other color from the group?
The only thing I would just add is we talk about traditional versus Roth, and so the key difference with these deferred accounts is when you pay tax. So a traditional IRA, any monies that you deposit in there, or traditional 401k, any monies going in, will be taxed coming back out. And so with the Roth IRA, you don't get a deduction today. Your income's a little higher, but you pay that tax, and it grows at a high, at a tax-free, income tax-free. And when you take it out, you have a lot more saved up that's not subject to tax. So,
And at least in Arizona, we have the benefit of creditor protection on the IRAs as well. So when little Johnny or Susie has all that money in the IRA, it's protected to some extent.
Yeah.
That may not be true for the listeners and viewers that are in other states, but at least that's the case here in Arizona. Okay. Next question. I know that I have to be an investor, but most of the things I read or hear about the economy and the markets worry me. I used to own a lot of CDs, and now I've got a lot of cash because CD rates are so low. Every time I invest in something, it seems I should have zigged when I zagged, and I've made virtually nothing the last 5 years in the money market. And I'm not getting any closer to being able to retire. A dilemma. Let me take a stab at this. The thing we all have to realize is that bad news sells. Shock and awe sells. There's always in the economy, there's always headline data. The first news release, the first press release about jobs, the economy, or this or that. Behind the scenes, there's always revised data. No one usually pays attention to what's behind the headlines. So the bad news, the shock and awe, it gets written about and people buy into it. Also, a lot of people, and this may be the person that asked the question. Many people that own investments may not be investors. They may be forced into it via a 401k plan, forced to be their own trust officer, or forced to be their own money manager by making selections. Lured into it because of low interest rates, or it's the last chance to salvage retirement, that they have to do something because they've had low savings rates. And there's a big difference between savers and investors, and you really got to know who you are. And you must understand what your core risk profile is. If you deviate too far one way or the other, then that's when the most bad decisions are made, because you're out of your comfort zone and you act out of fear or greed. And there's a big difference also between an investment and a portfolio. And a collection of investments may or may not be a portfolio. And a lot of people have an all-in approach versus having offsetting risk positions in place. and many have a tend to micromanage versus having the patience to allow things to work out. Those are some of the things I usually see when I see a situation like this, that someone has made investments out of fear or greed and they come out of them for the exact same reasons. Any other color from the panel on this dilemma for people?
Well, just a quick one. Market timing's tough. I highly recommend you don't do it. It really is hard because it takes exactly two correct decisions.
Yes.
One, when to get out of the market, which is not always easy, and just as equally difficult is when do you get back in the market. So if you're going to be an investor, as you described, an investor, you need to be into it, I think, for the long haul, and have your portfolio set up correctly so that you can withstand the ups and downs that are inevitable.
Exactly.
Yeah, I mean, the key thing that I wrote down that you said is fear and greed. Both of those things will lead to bad decisions usually. Fear, I sell out and then I'm in cash. Then I really have a savings problem when I'm not getting my expected return and I'm relying on that expected return to fill my retirement needs, right? So if I go to cash, I have to save up an awful lot of more money for retirement than if I were to be okay with something that's earning 6 to 8%. The greed is you stay, you keep going up and up. But greed. The other thing is that I thought of is you've got that friend that's selling you that hot investment. Is that greed or is that fear? Should you, and we've seen many cases where greed has caused people to lose a lot of money, and so that's something that needs to be balanced out. And I think, we're all professional advisors here, and if we've had those conversations during the downturn, it makes our job more difficult, but that's the good thing for you. It's that we want you to feel safe, we want you to feel that comfort, and so that's why you hire people like us. So, yeah.
Good comments. And 8 to 10 years ago, if you came out of an investment and held cash, at least you made something on your cash.
Right.
And at this point, it's a zero-sum game when you go from an investment to cash.
Well, I think the person that went to cash on March 9th, 2008, and then got back in maybe 2011, maybe they won. I don't know, but I don't know. Did they go to cash and then they get back in the next day? But they've locked in their 50 to 60% loss forever. So.
Yeah, precisely.
One other just quick thought, and that is taking on unintended risk. Oftentimes clients do that. They think that they're actually diversifying their investments, and sometimes they are, by maybe using multiple managers. Problem is, in those situations, oftentimes those managers don't know what the other manager is doing. And so while you think you're being a diversified investor and spreading out your risk, they may be doubling up on a risk position that they don't know the other portfolio manager may be doing the same thing. So if you have multiple managers, keep an eye on the whole basket of investments, not just on what one manager is doing and what another manager is doing. See how they work together, because you could be taking on unintended risk that would cause you some pain.
Yep. And we've seen that in 401k menus as well.
Absolutely.
Where there may be a menu of 18 to 25 or 30 funds, but 15 of them are large cap stock funds.
Yeah.
And you think you've allocated yourselves by using 15 funds, but hey, they're all the same thing. Yeah.
There's something to be said to have a complementary fund in the large cap space, but you don't need a duplicate. Yeah.
Exactly. Okay, moving on. There are several life insurance companies in the marketplace. What key ratings and elements should I consider to determine financial strength? Barry, this one seems printed just for you.
I'd be happy to address this one. There are a lot of insurance companies in the marketplace, and we find that if your approach to protection is long-term, we really encourage that a part of your decision would be based on establishing and researching the ratings of the insurance company that you intend to deal with over a long period of time. For example, if you intend to have maybe some form of permanent insurance, like life insurance, a whole life or a universal life plan, where you intend to have that coverage with that company for a long time, it's important to know their ratings. Very important, because today, believe it or not, there are a lot of insurance companies that are purchasing other companies. And it's possible that you might select a company based on a certain rating, and another company could acquire that block of business that might have a lower rating. So it's important, I think, from the get-go to research companies that have higher ratings. Within our organization, we have an A+ minimum rating for companies, and I'll get to that in just a second. But when I make a recommendation of a plan that goes into like an irrevocable trust that's intended to be permanent and long-term, I always recommend to the client, to the trustee, the A+ or A++ rated companies, because I like the stability there. And it's interesting, gentlemen, that I will say over the years that I have seen blocks of business sold from an A company or even an A+ company to companies that have lesser ratings. And I've actually seen it happen in the past where companies have been sold, or even blocks of business sold to a company that's even below our standard. And those are things that we think are a concern. So we think today, if your decision process is for short-term protection, maybe like term insurance, the rating of the company might not be as important. But then again, it may be, because if you're buying the right kind of term insurance, you want to have the flexibility and the benefits and the features of exchanging it or converting it to permanent plans in the future, if that's in your plan, to your goals and objectives. Now, there are 4 pretty much independent agencies that rate insurance companies' financial ability to pay claims, and this is important. The companies that we look at are Standard & Poor's. You can find them certainly on the internet, Fitch, Moody's, and AM Best. AM Best is usually considered the one that focuses pretty much on the life insurance industry. And they rate insurance companies based on their financial strength. And we think that that's very, very important. They have different ratings, different scales. They approach things differently. To one company, an A+ company may be an A to another. Sometimes they even disagree. And that's okay, and that's why sometimes what we'll do is, rather than looking at just one rating company, we'll examine all 4. And sometimes we'll even dive a little deeper into their financials. And the reason is because some companies, based on their mix of business, may have lower ratings because of that. For example, some companies that write life insurance might also write a lot of disability and a lot of annuities, and that might bring their ratings down through the rating services. So an A company may be very, very appropriate for a company that's writing disability income or annuities. But the key is we think it's important in the decision-making process. And we've also found that clients that have had blocks of business acquired by other companies, that can happen more than once. And administratively, it becomes difficult to keep track of who is my insurer at this particular point, and how do I stay in touch with the company, and so forth. And so we think it's an important thing. Certainly, if you have an advisor, your advisor can do all of that research for you. Steve, that's about what I
That's a heck of an answer.
Well, it's as long as I can go. No, I can go longer.
A question I was thinking about as you were describing that is, what is a client to do if they see their insurance carrier has gone through something like that, and now they thought they had a well-rated insurance policy and now they don't?
Well, it's a great question, and it just actually does happen. And I'll give you an exact situation. I did make a recommendation of an insurance plan to a client, and it was going in an irrevocable trust. And the insurance company that we utilized was an A+ rated company, and the company was actually sold to a B+ company. And so the thing that we have to do is to examine the contract to still make sure that it is appropriate to the needs and objectives of the trustee, the trust, and the client. But we also make sure that the financial strength of the company is there. So even though the company was sold to a B+ carrier, we considered, because of the surrender charges and expenses that would be involved, that it would be better to leave the contract with that B+ company after examining their financials. And it's interesting, that company was again sold to another company that was an A+ company. And so we have to examine that. Ratings don't always make the foundation for a decision, but they're certainly important to consider.
Sounds like a lot of good old-fashioned research.
It does. That's the truth.
Any other comments from the panel?
No.
None for me.
Okay, great answer. Next question is, I have heard about this new 529A account. What is it, and who benefits? James, that's probably something we can have you handle, I think.
Sure. So this new 529 ABLE account is the more common name for it. And then they're often in the same sentence compared to special needs trusts. And so the crux of this is probably a small man's special needs trust. It's designed to be less than $100,000 or so in value. It's designed that if it is less than $100,000, not to interfere with the disability income of the beneficiary. Beneficiary has to be disabled, has to be collecting Social Security disability, and so it's similar to other 529 accounts for educational needs, except this kind of goes a little bit beyond that, and includes things for their lifestyle need. And so it's not just books and education; it's specialized equipment or medical, similar to like a HEMS provision, health, education, maintenance support. I liken it to. So the question is, should you use this 529 A account, or should you still continue on with maybe the special needs trust? We can open up to the panel, but this one really does depend. It's the worst. It's the most commonly used tax answer to answer with. But my vote is, and with the flexibility that split interest trust offer, to still lean towards the split interest trust. The 529 account is nice if you can kind of want to build up a reserve if there's a concern where there needs to be $50,000, $60,000, $70,000 in this account versus hundreds of thousands of dollars. That's when you use the trust. So, but I'd love to open that up.
Okay. Any thoughts or?
Are there limits regarding funding the 529 Mabel account?
Annual exclusion limit, so $14,000 a year. Yeah. Yeah. So something to consider, and you've got to consider the other gifts that you're giving to this person as well. So if you've given them, $10,000 for the year, you can really only give them $4,000 more put into this account. And they are administered, I think, similarly by the states. So maybe you shop around for which state makes sense. But the special needs trust, it's administered just like a normal trust would be, trustee, brokerage accounts, things like that. I think, though, if you don't want to go through the hassle of going through an attorney and drafting documents, then the 529A account's probably for you. So, also.
Well, good answer. I know the one thing I've learned over the years is families that are facing special needs situations, they do have a complex road in front of them.
Yeah, and the biggest question, one of my friends, they're struggling with that too, is that, well, we want to provide for this person when we're not here. Who can we trust, and how can we do that? And we're not millionaires. These are normal people with normal jobs, and we've got to help them with a place to live, for their lifetime. We've got to help them with, who do you trust to write those checks? So.
Well, good answer. Well, let's move on. The next question is, we're back to an IRA question, and the question is, should I convert my traditional IRA to a Roth IRA? Greg, let's have you address this one if we could.
Well, this is one of those questions, I think, that the disclaimer you had earlier in the broadcast is probably very appropriate. This is a very individualized question, very personal as far as a person's circumstances. But again, there are some parameters that you might want to follow in making that decision. Now, what we're talking about here is converting from a traditional IRA to a Roth IRA. And as James alluded to earlier, regarding traditional IRAs, those are typically funded with pre-tax dollars, so that when distributions are made, they're going to be subject to income tax. The entire distribution is going to be subject to income tax. Compare that to a Roth, where those are primarily funded with after-tax dollars, and so the growth and the contributions in that Roth IRA, when qualified distributions are made down the road, they come out income tax penalty-free. So that's the distinction between the two. So when you go and decide to say, yes, I want to convert from a Roth to a convert from a traditional to a Roth, you're going to incur an income tax obligation on that amount that you're converting, on the market value of that traditional IRA. I think the first question you need to ask is, do I have the money to pay that income tax bill that's going to be due? That's question one. Two, do I have the money outside of the IRA to make that income tax payment? Because it's much more beneficial, obviously, to make that payment of that tax obligation not using IRA funds. So if the answers to that question are yes, then what you need to do is consider some other reasons why you might want to do so. One of the reasons you might want to make a conversion from a traditional to a Roth is if you happen to be in a very low income year or income period generally. Now you're in a lower income tax bracket. Hey, maybe I can take advantage of that fact and convert a traditional IRA into a Roth, knowing that eventually I'm going to be in a higher tax bracket down the road. It'd be nice to be able to get those Roth IRA distributions to me income tax free. Similar, not identical, but if you expect income tax rates to rise, given the national debt, given the Social Security situation and the baby boomers retiring, a lot of people think that naturally income taxes are going to have to be increased. If your viewpoint is that rates are going to increase in the future when you're going to be taking distributions from your traditional, perhaps now's the time to convert to a Roth and know that you'll take the lower tax bite now, the lower rates, versus when rates are increased down the road. You know, in 2008, or around that time, was a time when we had a lot of people converting from a traditional to a Roth IRA. And the reason for that is, with the financial crisis, the market values of our portfolios were reduced dramatically. So it was an opportune time to go ahead and make that conversion from a traditional to a Roth, knowing that the income tax is going to be applied to severely depressed values of that traditional IRA. So that was an opportune time. You can find opportune times like that in a very volatile market. One final thought is there's no saying you have to do a Roth conversion all at once. You can do partial Roth conversions. So to the extent you're in a tax bracket that you haven't filled all the way up yet, why not go ahead and convert that traditional IRA just to the extent that you don't move yourself up into the next tax bracket? You can do that over a period of years, basically kind of filling up those lower tax brackets every year without pushing yourself up into a higher tax bracket, and eventually have a complete Roth IRA conversion.
Okay. Any other color from the panel?
I'll just add from an investment perspective that when you convert when you, let's just say you convert $100,000 and the investment recommendation is 4 different mutual funds or things like that, stocks, you kind of want to decide, should I convert it into separate IRAs, not just one single one together? Because you do have an option, if it doesn't make sense, to undo it by the extended due date of the return in the following year. So you can decide, all right, so if REITs had a horrible year and I've got one account with REITs in it, I can undo that thing and then redo it, pay a lower price for doing the Roth conversion. Some clients like that. Other clients said, no, it makes sense in the long term, just put it all together and let's invest it as part of the investment IPS, investment policy statement. So, yeah. That's
Great point.
Yeah, that can be an excellent strategy, and I've seen some people do that for a series of years.
Yeah.
You know, converting 2 or 3, deconverting 1,
Yeah.
and continuing on. And in the end, it would seem, you know, not knowing exactly where tax brackets may be in the future, it might be nice to have a pool of money that's unaffected by taxes on a distribution to manage that tax liability when you're retired.
Right, we used to just have them as liabilities on the balance sheet, you know, but projected, changed every month, but you know, you've got the negative, you know, tax bite on there. So.
Okay, moving on to the next question. When I invest, should I hire an investment manager that manages my entire portfolio, or hire multiple managers to manage different pieces of my portfolio? I can take a stab at this, and I'm sure there's opinions around the panel on this as well, I'm sure. In my opinion, both work. I think that portfolios that are less than $5 million, in my opinion, it may favor a single manager over multiple managers, only because I know in our business, you know, our optimal portfolio size is $1 million plus, and that's where we get the most. We can do the best job for our particular client. So, and that's probably a common base out there for many managers. So if you take a $3 million portfolio and you split it amongst 5 to 7 managers, you've got 5 to 7 $500,000 portfolios, and that would seem to me to not be that optimal. And then someone has to manage A, the allocation between the managers, and then B, has to ride herd on making sure wash sales don't occur in the portfolios. And it may be easier, going back to that comment about investors and savers, to stay within your core risk profile with one manager. It's less of an institutional approach and more of a personal approach, more apt for customization, a cross-account type of management, whether it be a Roth IRA, a regular IRA, a trust account, etc. And I would think that I would think that in a situation where you've got a smaller portfolio and you're trying to get exposure to areas that might be outside of one manager's expertise, they can certainly use a variety of products like ETFs and funds and other tools to get that allocation to an international or a small cap, etc., that might not be $1 million allocation to something like that. It might end up being a $100,000 allocation or $200,000 allocation. And I think, lastly, one of the things that is really, I think, important in investment management is managing to the best after-tax rate of return, which is, I think, more challenging in a multiple manager approach. Any other thoughts or colors? Because there's 9 different ways to skin this cat, I'm sure.
There are. Well, I tend to agree with you. As I mentioned earlier, I didn't know this question was coming up about unintended risk taking. And when you add the managers like you're saying, and they're not in tune with each other, you're adding risk there, whether it be diversification risk, wash sales as you were describing. Unless you have somebody overseeing every manager and knowing what every manager is doing, I think there could be a problem there.
Yeah.
And I think, in my opinion, I think you should have that person overseeing all the managers. And it's not a position of judgment, it's a position of reporting. Mm-hmm. So if we all expect to get brokerage statements, get performance reports to see how we're doing, but you need that other advisor to say, all right, so how does this fit in the overall asset allocation? If one guy is one advisor is supposed to be doing the U.S. equity space, and then for whatever reason they decide, nope, we're going to do emerging markets, well, you've got to set some parameters around that. But in terms of, setting up the policy statement to say, all right, Mr. Smith is going to be doing this portion, and here's his risk tolerance areas, and incorporating that, I think it makes it more complex from a reporting and also financial planning perspective. I think it makes sense in the ultra, high net worth world, because the portfolio carve-outs are millions of dollars, not just a couple $100,000. But I think there's some added elements there, and it takes a lot of work to make sure no one's a competitor and that doesn't interfere with the client. And so that would be the biggest concern I would have, is these guys are kind of all wanting your money, but you're really not getting the best advice if that's the case. So
If you go that path, somebody has to manage that allocation.
Yeah.
And manage the manager.
And
it has to be an active role.
Yeah,
Mm-hmm.
and presumably it'd be the one with the highest amount. That's charging a separate fee to do that. Unfortunately, they're having to disclose it and say, hey, we're more expensive than this other guy, but that's the advice, that's the sound advice that you're getting. So.
And sometimes you get what you pay for.
Yeah.
Well, moving on. There are many kinds and types of life insurance plans. Are there certain plans that are better than others? Can I have more than one type at the same time? And how much should I have? Barry, I can't think of anybody better on this panel to answer this question than you.
I would be happy to answer it, Stephen. Happy to answer it. There are many different forms of life insurance out there, and sometimes that plays to the confusion of the consumer. There are so many different kinds, but they're designed for good reasons. As far as I'm concerned, I always try to lead with objectivity when I work with my clients. And I think that that's vitally important, because my number one responsibility as a planner, or the number one responsibility of a life insurance planner, is to know the client's objectives and goals first. That's most important, because I believe all plans are actually very good. It's just some are better than others when they're better applied to the client's objectives. In our industry, the life insurance side, we always try to maybe guide people away from the one-size-fits-all planner. You should buy this plan and only this plan. We always feel it inappropriate for us to impose our philosophy on a client based on what we think is good. So objectivity by your planner is very important, and I think that that's why it's important to have a planner that you work with specifically. So I would say that there are many different kinds. I have seen people dissatisfied when the wrong plan is applied to the wrong circumstance. I'll give you an example. We have a client that was referred to us, and this individual bought a temporary plan intending it to be a long-term plan. So it was a term insurance plan intended to be long-term, but what happened is where the individual bought it, they did not find that there was any conversion right to the policy. And what happened is when the policy got to 10 years old, when the rates went up significantly, the policy became 10 years old in a week, and the policy was only convertible during the first 10 years. And during that latter part of that 10-year period, the client developed a heart problem and now is uninsurable. And so now that client is stuck with that term plan with the high renewing rates. So I think I've seen people dissatisfied when the wrong plan is applied in those type of situations. To answer your other follow-up part of the question, you can have more than one kind at the same time. And it does happen sometimes where, let's say, a family has some debts and obligations and young children at home. And we want to make sure that if there was a premature death, that the income needs of the family and debts and obligations would be paid for if anything were to happen. But after the children are out of college and gone and everything's fine, the amount of insurance needed might not be as much. So it's possible to have actually a portfolio of insurance where you can have some term insurance and some universal life and some variable life. And so depending on the client's objectives, what you're looking to accomplish, you can have more than one plan working together at the same time. And since I've only taken 2 or maybe 3 breaths during this answer, how we actually help guide a client to how much protection they should have, again, that's our responsibility as a planner to know the client's objectives and what they're looking to accomplish. But to answer it quickly, we look at how much debt and obligation do we have, what are family obligations and family needs, are there any special needs within the family that need to be planned for. We want to make sure that if there was a premature death to one of the adults in the family, that pension income would be replaced. We want to make sure education is considered. So those are some of the things that we look at.
So would a good example of like a dual need life insurance policy be parents who secure debt for their children, and then also who need a mortgage paid off if they pass away unexpectedly, right? So you've got one super long term and then one super little shorter term.
Absolutely.
Yeah.
And we'll ladder those or stack those term plans where sometimes we'll have a 15-year term plan for a certain need, maybe stacked with a 20-year term plan as those responsibilities go away. Ultimately, maybe with the core of some kind of permanent guaranteed plan that'll be there for the long haul.
Yeah.
Okay, great color. Any other comments?
No, very good.
Okay. Moving on. What are the advantages and disadvantages of a 529 plan? Greg, let's have you take a
Sure.
stab at this one.
Sure, the 529 plan is a college savings plan. You know, it still feels kind of new to me, but I think this plan's been around, I think, since 1996. So it's been around a while. I think it's a fantastic plan, if for no other reason than the amount that you can fund it with, compared to other college savings tools. The 529 plan, you can fund that initially with annual exclusion amount $14,000. If you give split with a spouse, $28,000. But what's impressive with the 529 plan is you can front load 5 years worth of those annual exclusion gifts. So for an individual, that'd be $70,000. For a couple that's gift splitting, that's $140,000 that you can put into a 529 plan today and have ready for a beneficiary to use, which is, I think, a phenomenal deal. What is also great about the 529 plan is those assets that the owner of the 529 plan contributed are out of their estate. Not only that, the subsequent growth of those assets are out of the estate of the 529 owner. What's not out of their hands is the control of that account, which is really pretty impressive. They can change beneficiaries. So grandparents can set up a 529 plan for, let's say, the oldest grandchild. The oldest grandchild elects not to go to college. Well, maybe the following grandchild does. So now you can change beneficiaries and put it toward that next grandchild. As long as they're in the same generation, you can go ahead and do that. So it's a fantastic opportunity. Flexibility with changing beneficiaries. Again, the big deal is when distributions have to be made for qualified education expenses, they all come out income tax free. No penalties, income tax free for qualified education expenses. It's fantastic. Now, there are some disadvantages, but I don't think they're any different really than some of the other college savings programs. If you have non-qualifying expenses that distributions were made for, there's a 10% penalty. Now, that 10% penalty isn't on the distribution, it's on the earnings that came out of that distribution. So the corpus, if corpus came out, that is not subject to the penalty. If a non-qualified distribution came back to the 529 owner, not only will there be that 10% penalty, but they'll be subject to income tax as well. Now, I believe some 529 plans allow the owner to direct those non-qualifying distributions to the beneficiary, who presumably will be in a lower income tax bracket, so it kind of can alleviate a little bit of that pain. And one other cause for some concern, I guess, is you got to shop around because costs can be an issue. So you may want to make sure you do your due diligence and find the right 529 plan.
Okay. Excellent. Any other color? One question I always hear about 529 plans is you start to play this thing out over a generation. What happens if the account owner dies? Is there a successor owner? And can that literally go on for generations, or is there a stopping point at some point?
There is a successor owner, and I think it's designated in the 529 account agreement. I can't remember, James.
I can't remember either. But I don't think it goes on to perpetuity.
I don't think
Okay.
it goes on to
I think it
perpetuity
gets
either.
distributed out.
Right.
Okay.
I don't know though. It's never
Okay.
happened.
Okay.
I think the only thing I would add, I think on the 529 front, is make sure if it's a parent's funding the children, just to reiterate what you said before, make sure your retirement is set before you start contributing to these 529 plans, because your retirement is more beneficial to you to fund now, and so that's just something to consider.
We see mostly grandparents seem to be the
Yeah,
ones who want
grandparents,
to do this. Yeah.
It's a good way to reduce your estate, because with the triple or with the 5-year funding, you get an awful lot of money out of your estate if you've got 10 grandkids, doing that. So
Okay. All right. Let's move on, and I seem to be in a position where we have a little bit more questions than we do have time left on the clock. So we're going to pick up a couple here that might be very appropriate to year-end and tax issues. And I want to hit the one question about health savings accounts. I have heard about HSAs, health savings accounts, and aren't they just a use it or lose it plan? What if I'm young and healthy? James, this has got to be up your alley.
yeah, it's either James or Greg, one of the two. Because I'm going to lead into the investment conversation regarding the health savings accounts. But it's really a neat benefit of a high deductible health plan. And if a high deductible health plan makes sense for you, the key word is make sure it does make sense for you, because there's a lot out of pocket, and that's what these plans, these HSA accounts, are set aside funds for. And so if you're young and healthy, you choose the high deductible plan because that's the lowest cost to you, because you don't use the hospitals, doctors, things like that. It's kind of like a catastrophe plan if you get in a car accident or something. But the benefit is, all right, I get to set aside, I think, $3,350 each year if you're single. And if you have a family plan, so it doesn't really matter if it's married here. If you've got a family medical plan, it's closer to $6,000 or it's like $6,400 or $6,600 or something like that. And so basically these plans, they're not tax toilets. They roll over year to year. They think of them as a medical traditional IRA. If you're lucky enough to build up funds in this account over your lifetime, at age 65, they roll over just to regular IRAs once you kind of begin Medicare. But they're good. And the thing is, they used to be high fees, but there's more and more people getting in this market, more banks. And so if you change jobs, you can roll it over to a bank that you want. You can look at the fees, and they have investment accounts too. So,
Okay.
yeah, I think the big thing is if you're is to set aside maybe $5,000-$10,000 in your account before you start investing the account. So.
Excellent color. Any other comments or thoughts
Yeah.
on that topic?
I think employers like these plans as well. I know
Yeah.
some employers actually will, if you sign up for the high deductible plan, open the HSA account, they'll fund it with $1,000 right off the bat, and they may do so every year after that.
Yeah.
It's very, it's a neat program, and like you said, if you're healthy and
Yeah.
you can let that grow, it's
Yeah.
not a bad
just,
way to go.
Just make sure it's the right plan for you medically.
Exactly right.
That's what I say.
Excellent. Well, I think we should draw this seminar to a conclusion. I think we've covered some excellent topics, and I really believe the answers have been very high-quality answers. I do want to thank the panel. I want to thank the Central Arizona State Planning Council for providing the panel and providing the volunteers that are still answering questions behind the scenes, so that if your question that you had was not covered on this webinar, submit it via the Ask a Question link, and we still have professionals there that will answer your question to the best of their ability. This concludes our webinar on financial planning, and you will be able to access a recorded copy of this discussion on KJZZ.org. On behalf of KJZZ and the Central Arizona State Planning Council, we bid you good night.